Hello and welcome to our 2016 European Infrastructure Investors Survey. We're here today with Jason Clatworthy and David Scott, joint lead partners from our European Infrastructure M&A practice. And Jason and David will talk us through some of the key findings from the survey and also how they will impact investors across Europe. Welcome to you both.
Thank you. Thank you.
First question I have is on the title of the survey, Positive Horizon on the Road Ahead. Jason, what does that mean?
Yeah, I think it's a good summary of where we are actually, Ollie. When we last did the survey back in 2013, we were just coming out of the financial crisis and it was a pretty uncertain market. What we have seen over the last 3 years is a real growth in the market in terms of participants, number of transactions and confidence in the market. And absolutely, it's a market now that is showing very stable returns, very predictable pipeline of transactions, and importantly, a resilience in terms of the economic factors surrounding the transactions, and therefore returns are stable, which is what our investors are after. I can see that carrying on from now, and that is very much what the survey showed us. So yeah, I do think we're looking forward to a very positive road ahead.
David, Jason's just mentioned the competitiveness of the market. How do you see that's impacted the way that the market's operated over the last 3 years?
As we forecasted back in 2013 when we did the same survey, it has got more competitive over the last 3 years, and I think the key thing that we're seeing is that's had an impact on returns. So one of the questions we asked the investors was, what returns are you getting on your infrastructure investments? And overall, we asked the same question back in 2013, and broadly the range was 12 to 14%. And that's actually now fallen to 10 to 12%. And I think it's that competition, that increased competitive environment that has driven down those returns.
And are there any areas of the market that you've seen have performed particularly well or particularly poorly over the last few years?
I think overall, almost all have done well, and we asked them to look at their various investments and walk through a lot of different investment categories, and the overriding answer was they've done well. There has been some erraticness, and I think probably the area with most variable outcomes has been renewables, where the bulk of investors said their renewable investments had done very well. But actually more than in any other class said they'd done badly. And I think looking at that, why has that happened? Much of it comes down to regulation, and regulation in various countries around Europe on renewables has changed over this last 3-year period. And where it's been adverse, it's clearly had some impact on our infrastructure investors.
Jason, what risks do you see keeping investors up at night at the moment?
I think the overwhelming risk that came out from all of them was just the generic macro environment in which they're trying to invest. I think importantly that's playing out from a macroeconomic perspective into political risk, tax risk, reaching back to David's point, regulatory risk being a key concern for investors as they invest all around Europe. Indeed, sort of in excess of 90% of investors we interviewed thought that regulatory risk had got quite acute over the last 5 years. And more than 60% believe that's going to continue as a trend over the next 3 to 5 years. Therefore, that is clearly the one risk that there's a lot of work being done on when you look at transactions. In terms of where they see that risk manifesting itself the worst, interestingly, it was Iberia, Italy, and for the first time we've seen, the UK was quite prominent in the concerns to them around regulatory risk.
I mean, let me pick up on something there as well, because I think there is an interesting conclusion in terms of investors' appetite for regulatory assets. Now, regulatory assets has always been a core part of the asset class that infrastructure investors are looking at. But in this survey, for the very first time, we asked investors, how keen are you to invest in regulated assets? And whilst 60% of them said they were keen or very keen, 30%, and that's quite a high number, 30% said they weren't keen to pursue investments in regulatory assets. And I think there's an interesting conclusion that an asset class that is thought to be core to infrastructure investing, 30% of the investors are feeling is not somewhere they're looking at the moment.
And what about asset management, the sort of more internal focus? What are investors doing in the asset management space at the moment?
Yeah, I think firstly, Ollie, the interesting piece around this is coming to David's point, with this bubble and a pressure on returns, pricing going down, the expectations on management teams to be able to deliver on these assets has increased. As a function of that, undoubtedly, our investor base and our client base are being more and more dragged into the portfolio companies and investing their time a lot more actively now on boards of these companies to make sure they're a success. Indeed, over 90% of them believed they were very active at a board level in their companies. In terms of the areas they're working with management on, it's very focused around the financials. So strategic financial planning, business planning, delivery of business plan. And interestingly, for the first time in 2016, what growth opportunities are there in some of these assets? What acquisition strategy do they have and how are they implementing it? In terms of governance, again, that's an area that's got an acute amount of focus, which again, I think links back to David's point in terms of the interest of regulators in this space. And indeed, again, over 90% of them now think their governance structures would stand up as being excellent, opposed to 65% back in 2013. So again, it all comes back to managing these risks very proactively at the portfolio company to make sure they can deliver the returns that these assets are yielding.
David, in 2013, you predicted that the debt markets would remain buoyant. Have we seen that play out, and where do we feel that might be moving to in the future?
It has. Debt markets are definitely a good news story for the infrastructure investors, and all of them that we talked to were very positive about the current state of the debt markets for their investments. If anything, they were saying there was perhaps more debt available for each transactions than they were wanting to put on the transactions. So positive in terms of availability of debt, and pricing too, I think had come down from their expectations of where it would be back in 2013.
Jason, you also mentioned at the start exits becoming more prevalent. Is that something you're expecting to continue to see?
Yeah, absolutely. Referring back to the 2013 survey, that was one of our predictions. We would start to see the first of the exits of these assets from the first generation funds, and we've absolutely seen that. One thing we did get wrong back in 2013 was thinking there'd be a bit more activity in the IPO market. That hasn't materialised. Interestingly, though, I do think we're going to see a lot more going forward from now. And our 2016 prediction is that we'll see an awful lot more exits. In terms of the survey, we found that in the next 3 to 5 years, our investors are saying they're going to be disposing of somewhere in the region of 120 to 140 assets, which is a substantial portion of what they currently have, and indeed have exited all their assets within a 10-year lifetime. So yes, absolutely, I see the exit prediction being something that will continue into the future.
So you've both mentioned, as we've talked, a number of predictions that you have for the next 3 years in the market. I wonder if you could each just summarise maybe your top prediction, where you see the market moving over the next few years, and maybe Jason, you could give me yours.
Yeah, sure, Ollie. I think mine would be the continued emergence of direct investors. We're already seeing the Canadians, the Australians, and some of the Middle Eastern sovereign wealth funds play very actively in this space. I think over the next 3-4 years, we will see more Asian direct investors turning up from particularly Korea and China.
And David, a top prediction from you?
Well, I think I'm going to go for our first one, which is stability. I think notwithstanding what Jason said, I think over the last 9 years that we've been doing this survey, we started in 2007, the industry has reached a level of maturity now. We've got a lot of established management teams, we've got a lot of capital in the market. I think there's an established deal flow that is going through the market as well. And I don't think the changes that we're going to see over the next 3 years are really going to be seismic. So I think stability.
Well, thank you both. I think the message I'm getting is a really positive movement for the industry, and as the report says, a positive horizon for the road ahead.